Inflation. It's a word that makes headlines and sparks worry. But what does it actually mean for you? Inflation is when prices for goods and services go up over time. This means the money you have today buys less than it did yesterday. Imagine your dollar shrinking. That's inflation in action. Think about something you buy regularly, like a cup of coffee. If a cup cost $3 last year and now it's $3.50, that's inflation. When prices rise too quickly, it becomes a problem, eating away at your savings. Understanding inflation is the first step to protecting your finances. Inflation isn't random. There are concrete reasons behind those rising prices. One major culprit is increased demand. When everyone wants a product, but supply is limited, prices naturally rise. Remember the frenzy over toilet paper at the beginning of the pandemic? That's a prime example of demand pull inflation. Another driver is rising production costs. If raw materials, labor, or transportation become more expensive, businesses pass those costs on to consumers in the form of higher prices. This is known as cost-push inflation. Government policies, such as increasing the money supply, can also contribute to inflation. Global events, like wars or natural disasters, can disrupt supply chains and lead to price spikes. The interconnectedness of the global economy means that what happens in one part of the world can impact prices everywhere. Understanding the factors driving inflation empowers you to make sense of economic trends and predict potential price fluctuations. When inflation rears its head, your hard-earned savings are at risk. The money you've tucked away in a low-yield savings account loses purchasing power over time. This means that while you may have the same amount of money, it won't buy as much in the future. Don't panic, though. There are ways to protect your money. Consider diversifying your savings into higher yield options, like money market accounts or certificates of deposit, CDs. These typically offer better interest rates than traditional savings accounts, helping to offset the erosion of inflation. Keep in mind that while these strategies can help mitigate the impact of inflation, they might not completely outpace it. It's crucial to explore other investment avenues to ensure your money grows faster than the rate of inflation. Section 4. Investing wisely. Beating inflation at its own game. Investing your money wisely is crucial during inflationary times. The goal is to find assets that outpace inflation and provide real returns. One option is investing in stocks. Companies often raise prices during inflation, which can translate to increased profits and potentially higher stock values. Real estate is another asset class that tends to perform well during inflation. As prices increase, so does the value of your property. Plus, rental income can rise with inflation, providing a hedge against rising costs. Commodities like gold and oil are often seen as inflation hedges. Their prices tend to rise when the value of currency falls. However, it's important to remember that all investments carry risks. Diversifying your portfolio across different asset classes can help mitigate those risks. Section 5. The long game. Patience and diversification. Navigating inflation requires patience and a long-term perspective. Don't panic and make rash decisions based on short-term market fluctuations. Instead, focus on building a diversified portfolio that aligns with your financial goals and risk tolerance. Remember that inflation is a natural part of economic cycles. It's not a reason to avoid investing altogether. In fact, investing is one of the best ways to protect and grow your wealth over time. By understanding the causes of inflation and adopting smart investment strategies, you can weather the storms and come out ahead. Stay informed, stay disciplined, and remember that the best investment you can make is in your financial education.